All right, this is international paper. I'm going to do a quick valuation on this company. I did want to go over a couple things too um, while I'm at it, just to illustrate the fun as well as some of the problems with valuating these companies. Um, as you know, I'm using the price to book as well as earnings per share to give me a valuation on the stock. And so, of course, the first thing I do is I go through the quarterly earnings reports and the annual earnings reports from the company, looking at the balance sheet as well as the income statement to figure out what they own, what they owe, how much money they're making, things of that nature. Now, these reports are filed with the SEC, so we have to assume that they are correct. It's no different than filing a tax return, right? Um, of course, we all know in the past there have been issues with companies lying on their reports, and I think the biggest and probably most famous is Enron, right? Um, but we have to assume that the numbers are correct unless we see something glaringly crazy in the numbers. So what I did was, of course, I went out looking for earnings per share and price to book value, just to compare what, for lack of a better word, the market has versus what I've calculated, right? And so, just to go back real quick, I have a price to book ratio of 2.79, and I have earnings per share at $4.89. Now, my calculations are really straightforward and very simple. The price to book simply takes today's price and divides it by the price per share. Okay, and again, this is based on the number of shares outstanding. Okay, there is some funny business that goes into buying back shares, treasury shares, and things of that nature. And I don't dive too deep into that because at the end of the day, the shares currently in the market are the number of shares outstanding. Okay, it's not common for companies to issue new shares. In a lot of cases, if they do issue new shares, they typically have some type of buyback program in place anyway, to keep sure, I mean, to make sure that it's pretty level. You do have some companies that buy back a lot of shares and add them to treasury, but that takes them out of the market, right? And so again, we're looking at how many shares are actually out on the market, not what the company may own. Right. So again, price to book 2.79, earnings per share $4.89. Looking at Zacks has an earnings per share of $3.28. And I want to get to, there we go, in a PE of 16. And so earnings per share, right, and price to earnings um, all have to do with earnings. And so PE ratio is higher than mine, which came in at 1113. So 1113 is my PE ratio. They have 16.5. How they got that, I don't know. But obviously their earnings are less than mine. And so if you have the earnings on bottom and the price on top, then the PE ratio will be higher if you have less earnings. Again, I calculated my earnings simply based on the last 4 quarters of net profit. Again, that's been reported to the SEC. And so you simply take the total amount of net profit over the last 4 quarters. And again, you divide that by the number of shares outstanding. Okay, and so that's how I got 489. Take a look at this one. Okay, so this one is from the NASDAQ. The NASDAQ has a forecast as of December 2021 of 4.82. But of course, they have other analysts that are doing these things, right? And so again, that's kind of the fun of this is every analyst kind of has their own way of doing the math to come up with these numbers. And so personally, again, my forecasts are simply based on previous numbers. I don't try to get into is the company going to perform better this quarter versus last quarter. I don't get into that. I just look at what money has been made and make my decision based on that. If they make more money next quarter, that's great. I should see the price increase. If they make less money next quarter, then I can expect the price to fall. That's just kind of how it works. But again, they have 7 estimates, and the estimates range from 4.7 up to 4.9. And again, I'm at 4.9. So I guess that would put me closer to the higher end of the forecast. So that's that. So that's NASDAQ. The NASDAQ also has a PE ratio. And again, I don't understand this. The 2020 actual is 19. And I guess what's happening is they're calculating PE over the course of a year versus kind of a day-to-day thing. Their 2021 estimate is 11.26, which again is very close to my 11.13. But again, they're saying it's an estimate. Print an actual PE ratio until the end of 2021. And then just for fun, if you go out and you simply Google IP PE ratio as of today, NASDAQ, then what you get is a PE ratio of 19 as of today. But then again, you see this forward price to earning 1 year, which I'm assuming is something of a forecast of 11.21. And then you see earnings of $2.88 is $4.82, or yeah, that's being forecasted. So it's really weird, but it does give me a lot of confidence in my numbers because they're not exact, but they're fairly close. There's a couple others. Yeah, so again, this is a PE ratio. This is from Zacks. They have a PE ratio of 16, 17. But what's really interesting is that you come down here to early 2020, and they show the PE ratio went all the way down to almost 7, which was really weird. Macro trends, another shows that the PE ratio, they show it at currently 19, which is a bit higher than 16, 17, right? But they show that it never got any lower than where it is now for the whole year of 2020. So, when I see stuff like that, I kind of just want to throw away the entire chart. I mean, like, what good is it? It is completely out of sync with what you see elsewhere. The other thing is that I definitely do not want to go back and try to calculate PE for the last three to 5 years. That's something that I definitely rely on these other websites and analysts to do for me, so that I don't have to. So what I did is I took the current PE, okay, and I just looked back over the last 5 years using this chart because I think it's more representative of kind of what has happened with the PE ratio, and so we see that it did about 6 or 7 back in 2018, But because my PE ratio is much lower than their PE ratio, I have to do a little bit of math to get a similar number. Okay, so um, what we have here, and this is actually, wait, here we go. All right, so we got a PE ratio of 7 as worst case scenario, and we have a PE of 13.75 as the best case scenario. Um, at current, it stayed the same. Of course, that gives us a price of $54.39, which is where we currently are. But if we see the PE ratio creep up, we can see prices go to 67. And worst case scenario, we can get all the way down to 34. If earnings increase, and we'll talk about that here in a second, if earnings increase, then we can see the price going to 63 at the current PE or as high as 78 at the highest end. The current trend, and I think I have this up here. Not sure. No, I don't have this up here. But the current trend for IP is that they have beaten their earnings over the past couple quarters. But in general, though, it is a losing business. That's a lot of the reason why they spun off the paper portion of the company to try to get rid of that old business, because a lot of offices are paperless now, right? And so IP, the big company has for a very long time been moving more towards boxes, labels, things of that nature that are more in line with the Amazons and the Walmarts and stuff like that, of retail today. They're doing a lot of like posters, advertisements, stuff like that. And so, is that going to drastically help earnings? We don't know, and we won't know for at least a couple quarters, if not a year. So I don't expect earnings to increase much. I do expect them to possibly decrease, because again, that has somewhat been the trend, right? And so we're looking at if earnings decrease, and again, this is by one standard deviation. Pretty sure that the actual numbers will be somewhere in between the current 449 and 405. And so that gives us a price of anywhere from $45 to $54, and then on the high end, $55 to $67. The worst case scenario, 28.38. That would have to be almost end of the world in order to see that. With the price to book, I did the same thing I usually do. I always take the assets and discount them, just to give me a worst case scenario, a little better, and then the actual numbers. Trying to remember. No, I included everything. So the actual numbers includes absolutely everything. Again, the only thing I didn't do is I didn't play around with trying to get an exact number on the number of shares, simply what is currently outstanding. Okay. And so that gives us a price per share of $19. Of course, we have to add a multiplier to that. Currently 2.79 is what I'm at. Everything I've seen that I've showed so far is it's about 2.5. So again, I'm a little off, but very close. And so that gives us our current price of $54. On the low end, $32.54, and on the high end, $84.56. On average, that price to book is including the actual numbers as well as maybe like a worst case scenario situation of $40.57. If I were to only use the actual numbers, I am curious. That gives me a price of 57. So if we assume that everything is going to continue as normal, we're not going to have any changes, that puts IP currently undervalued by about $3 a share. If we include, again, some extrinsic problem, that would somehow reduce the book value of the company by literally, I want to say 15%. Let me double check. Yeah, 15%. That means everything that they currently own would have to be discounted by 15% somehow. Um, Over the next, let's just call it a year, right? Honestly, our investment horizon is not typically a year, but you definitely want to be, for lack of a better word, you want to be ready for that if it happens. If you have to hold this position for an entire year, you want to be ready for that. And so that's the reason why I'm always being conservative in my estimates. Honestly, though, $40 seems really low. If this thing gets down to $40, I can say that that will be a good thing, right? I mean, the market would really have to have a big, big dip for that to happen. But if it did happen, I'll say that that would be a great thing, and we'll definitely want to purchase more shares. On the PE side of things, again, IP looks undervalued, 56, 34, and that's including some of that worst case scenario stuff that we talked about. No, I'm sorry. No. Let me take that back. No, 5634 includes best case and current case scenarios, and that's the reason why you see it a bit higher. But again, the trend has been that IP is losing money. And when I say losing money, I mean the net profit has not been as high as it has been in years past. Okay, so they still have a profit, right? But the profits have not been as high. And again, that's just because it's a business that is kind of slowly going out of business. Paper is still important. Like I said, we have a lot of boxes, a lot of labels, people doing a lot more shipping and stuff like that. But as far as just paper, there's not a lot of that going on. The company that they spun off is still going to, I believe, pay a dividend to IP. So that's pretty cool. But again, business is kind of going down. So what I want to do then is I want to see what happens if I take out the best case scenario and add only the worst case and current case. Let's see what number we get there. I know it's going to be lower, but I'm really curious to see how much lower. So 4750, which really puts it in line with the price to book. And then if you look at it that way, again, talking about worst case scenario and current, we have a price at about what, 45, we'll call it, 87, 40, yeah, 44 bucks. And we're currently at 54. And so what that means to me is if we're looking at worst case scenario, price to book, and current, 44 is in between those two numbers for sure, no doubt about it. And so I would say that the numbers make sense. And again, if we're including worst case scenario, then we have a price right around 40. If we have only the current case, um, then we are fairly valued at the price as it is today. Um, so what I'm going to be doing is I'm going to be looking at, and let's see if I have this put up. I think I do. What I'm going to be looking at is options, and let me just pull it up real quick, because honestly, I don't remember. Taking a while to load. Oh, there we go. All right. So what we're looking at is we're looking at trying to purchase shares. And the question is, are we going to be able to purchase shares at the $44 mark? Let's take a look at November. That's calls. All right. So there, as far as I can tell, November, um, there is absolutely no activity at all. See if I can. It won't let me do it. Get the amount. So it looks like there's absolutely no activity until we get down to $58. And this is something that I've struggled with over the last couple of days because of the spinoff. The options have been really weird. They finally kind of normalized today, which is exactly why I'm doing this video. But as you can see, even on the NASDAQ site, the options are still weird. This thing is saying 60 cents purchase at $58. Price is at 54. And so what I think is happening is that when you go to purchase shares for IP right now, there's two options for each option. And you can purchase just the shares, or you can purchase the shares plus shares of the new company. And so that has really thrown things off a bit. Let's see if Yahoo is doing any better. To go out to November 5. And really, I want October 29. So that we can make the money and then report it by, if it expires on the 5th of November, then we have to wait all the way until December before reporting it. And that's just because I do the updates and I do everything once a month. And so these are calls. Let's take a look at puts. All right, here we go. So October 29, and there you go. So you can, oh, yeah. See, so you are only able to purchase shares at $51. Like there's nobody willing to sell you their shares for anything less than 51, right? And so I think that says something too about where the market thinks the stock price is going to go. No one thinks the price is going to get anywhere near $47. Not within the next month anyway. So let's go out a little further. Because remember, like I said before, if we use the worst case scenario, I'm thinking that's a holding period of at least a year. You know? So just for fun, let's do that. Let's look at January 2023, and that's about a year from now. And let's see what the market thinks the price may be. And so, yeah, so you can make what is it? $3,000 to purchase. Wait, is that calls? It's got to be calls. Okay. Puts. I was about to say, you can make $3,000 for purchase at $20. Let's do that today. All right, here we go. So, January 2023. There is someone out there that thinks that the price can make it down to $20. And so, again, for me, that's the fun of the market, right? Because in my mind, I'm thinking to myself, there is no way. I've just done this math. You see my point? Like the company, even if they sold everything that they currently own, the stock is still worth at least $20 a share. And then if you put a discount on it, like just assume that maybe they have to sell everything fast, you know, $8 if they have to discount everything by 15%. And also too, I have to say that, you know, when I do these worst case scenarios, I don't include goodwill, which is basically the value of the brand name and stuff. I don't include that stuff. I do include it when I do the actual numbers, just because, like I said, that's what's on the books, but not when I'm doing worst case scenario. So the stock is worth at least $8, you know, without any sort of market multiple on it, if they had to sell everything and just issue cash, right? So the idea that the price can make it down to $20 is really laughable. But hey, you know, stranger things have happened in the world, right? And so the question then becomes, all right, well, is it worth me taking $5 from someone on the chance that the price gets down to 20, and then I'll have to actually buy 100 shares for $20? Chances are this option is going to expire worthless. I'll be able to keep my $5, but for me, it's not worth $5. Just not worth $5. Keep going down the list, and we get to 45, and it doesn't look like there's any action there, but there's a price, $3.30. What is that for? Okay, so the actual price on this particular option is $3.30, but there is no one that's taking the other side of this bet, right? There's no one that's willing to purchase or bets that the price will fall below $45 within a year. right? There's nobody willing to take that bet. And that's the reason why we're not able to make any money on that. Because remember, when we sell a put, we're selling it to say, hey, man, um, if the price goes below, you know, $45, I want to buy your shares from you, right? And there's no one willing to do that. And that tells us that the market thinks that the price is going to go up versus down. And see, we can see here that there is someone out there willing to sell their shares at $65. And let's see, five. Well, I just do the math in my head. $65 minus roughly $13 is $52, right? And so what this means is right now today, someone is willing to pay me, right? 12, well, let's say $1,300. They're willing to pay me $1,300 right now today if I will purchase their shares from them at $65. Okay. And the only reason why they would ever do that is if they think that the price is going to be below $52 by next year. See, so there are people willing to bet that the price will be below $52, but no one's willing to bet that the price is going to be below the $42. No one is willing to bet that. And so again, that goes back to our numbers and saying, well, if the numbers we're coming up with, which includes worst case scenario, is in that $45 range, right? And the market doesn't seem to think that the price is going to go there, then more than likely the price is not going to go there. So we have to assume that our current case and best case scenarios are what's actually going to happen. And again, to be conservative, I'll say that the current case is what's going to happen. And so we'll be looking at possibly getting shares just a little bit under the current price. So let's see what the options are on that. And again, I really want to do this October 29. Because otherwise I have to wait until November before doing it again. Oops. All right. So let's see, 53, 54. And see, so this is the interesting stuff right here. So as of right now, October 29, no one is willing to sell their shares at $55. But there are persons looking to sell their shares at $54. And so I think what that means is that if the price gets above these numbers, like no one wants to sell. They're like, why would I sell? Just hold the company and let the price keep going. 6, 5, yeah. But we do have some action at 54 for some strange reason. And then looking pretty good here at 52. And so right now, someone is willing to pay us $45 to purchase their shares at 52 if the price goes below $51.55 by October 29. So let's see what happens if we go out just a couple days further, November 5, and see if there's a big difference in money. Right, so 52, or we have $100 at 54, but only $25 at 52. So as of right now, it looks like the October is actually going to be a better deal. Take a look at November 12 now. You get out of these. Yeah, again, it's weird, how the market works that way. So just a couple days after the fifth, the only action is really at 54, and it's a lot less. So again, October is looking like the better deal. Let's go out one more. November 19. And all right, so this one is actually a bit better. So someone is willing to pay $115 if we purchase their shares from them at 52.50, meaning that the price would have to make its way down to 51.35. But again, we're talking about November 19. That's almost well, it's still, it's a little more than a month. But we can make $45 right now today, and we only have to hold this thing for what, like, what's it, 20 days? So definitely going to do that. IP, just based on, and I don't think I have this pulled up. No, I don't. But IP is definitely a company that the program is calling for us to own. We're currently under allocated. Name the program wants us to make some money on this option. If the price falls, then great. We'll be able to purchase the stock at less than what is currently valued at today. And if the price does not fall, great, because we're making money on the current shares that we do own, and we'll keep our $45, and then we'll be able to do it again to sell another put before, after November 2nd. We'll be able to sell another put and put more money in our pockets and continue doing that until the price falls enough for us to actually purchase more shares. So that's it, International Paper. We do have a earnings call coming up on the 27th, so I really look forward to diving into that and doing a video on it. If you have any questions, please feel free to reach out. Till then, I'll holler.